This lesson looks at a flexible exchange rate, an unanticipated or unannounced, unanticipated permanent increase in the nominal money supply. This is the domestic nominal stock of money increasing permanently. Couple of things to note here. Because it's permanent and it's the money supply, we're going to see an increase in the money supply in the time path here, and that will generate an increase in price level over time. This increase in the price level will have an effect on the permanent exchange rate. Therefore, the expected change in exchange rates will move. Last but not least, the foreign market doesn't get affected at all. So I can just leave this untouched. Let's look at this now, slowly, step by step. First of all, let's imagine simply a 10% increase. It doesn't matter what it is, but it just gives us a tangible number to play with. So it is unanticipated, so the immediate effect is that this just increases. The result is an immediate drop in the nominal interest rate. Because it's permanent, we know money went from here to here and just stayed. So we are going to get an increase in the money supply like that. We'll assume this total jump is 10%. Because this rose permanently by 10%, we know eventually this will rise as well by 10%. The overall price level is assumed to adjust slowly, and so it begins to rise like this. That means inflation takes off, prices begin to rise, and they slow down as they approach this total change of 10% here too. Okay. Down here, because this is just big M over P, we see that the numerator jumped up, but the denominator didn't change yet. So right at that time, we get a jump up like that. From here on out, if nothing else changed, this would look just like money. But the denominator continues to rise along this whole path. So it slowly returns back down to its path following this. The interest rate, well, we've got to finish the graph up here. This part here needs to feed into here. So once this price process begins to kick in, people demand more and more nominal money as prices rise. And eventually, money demand rises to here. And so interest rates slowly crawl back up to their original level. So what happened? Interest rates dropped, and then they eventually returned to their normal level. Now notice, because this rose by 10% and this eventually rose by 10%, the money supply came out by 10% and the money demand moved out by 10%, which meant the cost or price of money, which is the interest rate, stayed constant in the long run. Because this is our initial and final interest rate, or what we might call our long run steady state interest rate, it never moved, and so expectations of interest rates didn't move either. But because the price level increased, two things we know are going to happen. One, permanent increase in the price level means this, which is one of the prices in the economy, will be higher in the long run. And there's a process that gets us there. We can expect starting here that prices will be higher there, which means we can expect starting here that the exchange rate will eventually be higher. Because we know the long run final steady state exchange rate, will be higher, one of the first things that happens is this increases. Now, I didn't label it because at the same time that happens, the interest rate dropped. So we went from here, A, right past here, all the way up to here, which is B. Okay? So that's where we jump to immediately. But eventually, interest rates come back up, right? We see that here. They rise back to where they were initially. So interest rates drop and then slowly crawl back this way. As they do that, we return to there. So, the exchange rate jumps past its long run level and then declines to its long run steady state. This total change right here is 10%. So that the final change in the exchange rate is 10%, the same as it is here. But the initial change is an overjump. So, the domestic currency permanently lost some value, in our example 10%, and overshot initially, reflected in a drop in the interest rate, which meant the return on domestic currency was lower for a little bit, and its value also decreased.